Following its stock split, Oppenheimer is increasing its price objective for NVIDIA from $110 to $150, which is good news for the chipmaker. According to the analyst who made the call, NVIDIA is experiencing sustained outsized top-line growth due to a number of tailwinds. And Brad, we observed a number of price target increases. Additionally, analysts at Argus Research and Goldman Sachs increased their respective price estimates. Following significant gain in 2024, Argus now predicts that NVIDIA's stock will continue to rise in 2025. As a result, all of these analysts now see a lot more space to run as they expand beyond the data center and look at potential in some of their other business sectors. This is a company that has been on a tremendous run, up almost 150% year-to-date. Indeed, both last week and this week, Goldman and Evercore ISI were out with their notes early. Taking everything into account, ordinary investors may be more concerned about NVIDIA's cost, particularly given Goldman Sachs' discussion of the DAO AI play in general. Since the remainder of the market is attempting to shift towards applications, it is now more important than ever to determine where they can continue to see some of that chip demand. The applications that sit on top of the models, which in turn sit on top of the chips, are what it means. Therefore, if you have the chips already, and they will continue to expand, you consider the inferential technology that these companies discussed at Computex a few weeks ago, or even 2 weeks ago, when everyone was saying, sure, we have 60,000 chip data centers right now that could easily get to a 1 million chip data center. NVIDIA continues to gain from that. Because of this, analysts have appeared on our show to discuss how, yes, the market cap that has grown to $3 trillion may still be the beginning point, which is absurd. One issue I had was if we had hit a ceiling or whether there was still potential to run, particularly after the 10-for-1 stock split. Analysts and guests on our show have consistently told us that there is more space for growth. There are some possible growth prospects in the gaming and automotive sectors of the company. In this case, Oppenheimer is giving NVIDIA the best positioning stature in terms of full-stack AI hardware, networking, and software solutions. Therefore, we'll keep an eye on NVDA shares here throughout the week. You were purchasing NVIDIA at $4 in 2014 before it was popular. Back in 2021, Kathy, you took advantage of the surge in the specific stock to reach $330. However, the flagship RK Innovation ETF sold out of its primary stake back in January, so you missed the most recent rise. Why? Indeed. Therefore, if you, we have a lot of faith in NVIDIA. We have a very favorable opinion on NVIDIA. In the fourth quarter of last year, when it was close to $100, we bought it down. Then, while several of our other AI-focused equities froze, it tripled. You see, we're examining the relative values of names in the AI space, which, despite popular belief, many people do not think about us. We also looked at NVIDIA, which is currently at 25 times sales, and Tesla, which is arguably the most significant AI story at 6 times earnings. UPath yesterday, 6 times revenue, not earnings. According to an YPath report from yesterday, it is a stunning AI play with 6 times sales. And there are a few reasons why we pause when it comes to NVIDIA. At a compound yearly rate over 5 years, it still achieves our minimum hurdle rate of return of 15%. As a result, it appears in some of our more niche portfolios. Yes, we are searching for better deals. However, cyclical hazards would be among NVIDIA's risks. I start to consider the cyclicality of a group when I hear shortages pertaining to GPUs or anything else. Competition. Tesla is developing a chip of its own. Google and Meta platforms each have their own processors for larger, more specialized language models. Next is the technology itself. According to Meta platforms, the Llama model can accomplish more with more data and less processing power. It can produce better models. As always, there are advantages and disadvantages to this situation. What number of IRID investors have contacted you through Twitter or other channels where you interact with your own purchases or ETFs? The fact that you maintained money in some funds but not the main RK ETF must have caused a great deal of annoyance. The majority of those who comprehended the NVIDIA narrative, I'll tell you. In 2014, right up until 2021, we were beating the table on it. And a lot of others may have held it in addition to adding it to their own portfolios. There hasn't been much opposition. People are aware that we are working on AI, but we are doing it in a somewhat different method, which is the reason. These days, NVIDIA is a check-the-box stock. The valuation is where it is because of this. However, we are searching for plays that have not only the management team's vision and wide distribution, but also proprietary data and AI know-how. In the same way that most people did not realize that NVIDIA was an AI play until very recently, we are just shifting to another set of plays that they have not yet identified. If you would like anything further refined, please let me know. You suggested MuiPath or Palantir, respectively. You mentioned Tesla. Although the number of AI-focused names you have is very small overall, there are quite a few. Is there something I'm missing? Does your flagship fund have a lot more exposure to AI? Or are you simply choosing to support a select few well-known companies? No, another name would be Twilio, with the exception of, really including multi-omic firms like Exact Sciences. Practically every business uses its own proprietary data and extensive distribution networks to obtain knowledge and develop better goods and services. We ask, how are you harnessing this powerful tool called artificial intelligence? In one form or another, and I would argue that practically every company in our portfolio is. And 90% of the names in the portfolio, in my opinion, are using it and actually possess proprietary data. What drew my attention, and we've already witnessed a great deal of disruption to firms' market capitalization, was when they were disrupted by, say, a ChatGPT. See, the education company comes to mind. However, you pointed out that ChatGPT systems might disintermediate Apple's App Store platform, for instance. Is that an important business that we should be concerned about being disrupted? What other names seem to mind that, in terms of how much this new competition could overwhelm them, the market may be misjudging? In any case, ChatGPT was either the worst or possibly the best thing that ever happened to Google. However, we often assume that ChatGPT and other chatbots will disintermediate it. We won't require the type of search traffic, and thus, advertising, that powers Google's business strategy. That is why we are concerned about it. As you mentioned, a lot of individuals believe that social commerce, the practice of people shopping on social media platforms like Instagram and Pinterest, will likewise disrupt Amazon. They also believe that social commerce may disintermediate Amazon. Customers would go straight to the source if they said, I want exactly this kind of item at the cheapest price anywhere in the world, using ChatGPT and other AI techniques. Therefore, we would say that every platform that has acted as an intermediary is vulnerable. As you can see, NVIDIA shares have remained stable in spite of the market's general sell-off. Seema Modi has some headlines for us based on CEO Jensen Huang's speech this hour. Seema? Jensen Huang, the CEO of NVIDIA, is arguing for accelerated computing and the crucial part NVIDIA plays in enabling faster models to run inside data centers. Additionally, he is defending the cost of the business's servers. Despite replacing thousands of nodes, NVIDIA's servers appear pricey and can cost up to a couple of $1 million per rack. The astounding thing is that replacing all of those and consolidating into a single rack is less expensive than simply replacing the cables that connect outdated general-purpose computer systems. At the Communicopia conference hosted by Goldman Sachs, the remarks were made. The CEO of Goldman Sachs, David Solomon, who is facilitating this discussion, then raised an important query regarding AI's return on investment. According to Huang, it's helping businesses cut expenses and increase efficiency. Businesses are cutting computing times by roughly 20 times by utilizing NVIDIA's GPUs. The initial wave still includes that genie. Every dollar customers spend with us results in around $5 worth of rentals because of the high demand. Additionally, he claimed that developing and then applying AI models, a process known as inference, requires less energy, which will benefit the business. Although they remain below the day's highs, shares are currently higher. David, please let me know if you need any further changes or portions of the script.